We're going to talk about kind of key themes for next year. And if you've had a meeting recently, you know these key themes are similar, and they go the same for periods of time until something drastically changes, like the Fed policy changes, major political things change or something like that. So the Federal Reserve is the key to everything. The Federal Reserve chairman came out in December, which is another reason why the market kind of got weak in December and January, and said he didn't think they were going to reduce rates more than 2 times in 2025. And I said, why would you say that? You don't know. It should be data dependent. Like, you don't know what the market's going to be with all the changes with potential tax cuts or not having tax cuts or tariffs, oil prices, all these variables. You don't know what the economy is going to be in December of 2025 versus December of 2024. So don't say things like that. And the Fed used to never do that until the financial crisis, and they would come out now, and now they're like all celebrities, all the Fed governors. So I think, and I'm going to go on a limb here, that the Fed is going to end up reducing rates more than 2 times next year. I don't know when it's going to be, but I think if some of the things happen that we think are going to happen, we think the Fed will end up at least reducing rates, at least 2 times, they said, and probably 2 more times. So, and this is really the second point, is why I'm not saying this is good for the environment, not saying this is good for global climate change, not saying it's good for any kind of other things, but the current administration is very pro-energy. And they believe that by reducing energy prices significantly, that's going to be good for the economy. And I will say this, that if you look at the CPI, the Consumer Price Index, the 4 biggest drivers of volatility in the CPI are energy first, food second, labor third, and housing fourth. Now, energy goes into all of those other 3 things, especially food prices. So if you lower energy significantly, that will lower the CPI. The CPI spiked just a little bit in December, and it did because if you saw oil prices or gas prices, you saw gas prices were at like $2.50, and then they went right up after Christmas time frame, early January, back up to $3. Well, that raised the CPI up a little bit, which drove the Fed to say that they weren't going to reduce rates. There's a lot of petroleum and energy goes into food production. Harvesting of food, fertilizer, the transportation of food, refrigeration, preparation, raising cattle, all that kind of stuff. Prices on the farm. Lexi, if you don't know this, is from a farming family in Owensboro. And I was talking to her dad in December, and he said that in 2022, the farm's fuel bill was $60,000, and they farm a 1,000-acre farm. He said in 2024, or 2023, it went down to about $50,000. This past year, it was $45,000, and they're budgeting it to be down lower than that. Now, for a small family farm, or even a medium-sized family farm like that, that's a lot of money that just gets burnt up in the atmosphere. So we think that it's really hard to push oil prices down substantially, and a lot of the oil companies, they like oil. The oil companies and OPEC like oil at 70, because it's not real high where it causes a supply shock or a demand shock, and it's not real low where it causes a supply shock where there's an excess on the market. So they like oil in that $70 range, so they don't really want to overproduce. But the administration, I was watching CNBC this morning, they're talking about doing incentives to give oil companies the incentive tax breaks to drill new holes in the ground. So that's probably going to go through reconciliation, so there probably will be excess oil in the market, which will drive oil prices down. What that does, again, if you think about the average person out there, the average family makes somewhere between $80,000 and $100,000. That person that's filling up their gas tank, if they're saving $20 or $30 a week when they fill up their gas tank, that's a substantial amount of money to somebody like that. I mean, they're like $120, $150 extra a month, and that money goes into the economy. So if oil prices go down, which drives gasoline prices down significantly, all that money, instead of being burned up in the gas tank, now goes into the economy, into consumer goods, either food, into tennis shoes, clothing, other types of consumer stuff, a refrigerator maybe, whatever. People are able to buy that instead of using it on transportation. So we think that the administration is probably going to achieve some sort of lower energy prices this year. They've already come down and they move in advance, and so that's why from the summer to now, oil prices or gasoline prices instead of having 3 in front of them, have a 2 in front of them. So the other thing that's going to happen is, which is really going to be interesting, is the administration wants us to be the largest exporter of natural gas on the planet. And they're talking about within the next 5 to 7 years, the U.S. could be an exporter of up to $4 trillion of natural gas to Europe and Asia. We don't want the Asians, we don't want South Korea and Japan buying natural gas from Russia. We want them to buy it from people in Alaska, because we're friendly to them and Russia's not so friendly to them. We don't want if you saw, Zelensky, speaking of geopolitical threats, Zelensky did not renew the contract with the Russians to bring natural gas through Ukraine during the next year. So the Russians are kind of jammed on being able to sell natural gas to the Europeans. So Trump has already announced that he's going to reopen the liquefaction plants and production and liquefaction of natural gas and to transport natural gas to Europe. So this could be the S&P or the GDP is probably somewhere around $25 trillion or so. So $4 trillion is a big number. That's almost 20%. So we could grow GDP closer to $30 trillion by exporting natural gas. Again, I'm not saying it's good for the environment. I'm not saying it's good for global warming. What I'm telling you is that's where the road is happening, and that's going to create major growth in our economy in a lot of different levels and lower prices of energy in general. So the tariffs, tariffs, if you look at an economic book, tariffs are inflationary and bad for the economy, all other variables held constant. And that's what people don't ever say. You hear the media and a lot of business leaders saying that if Trump enforces tariffs, that it's going to be inflationary. Well, the last time that Trump enforced tariffs, it was not inflationary. So you'd say, well, why was it inflationary? Why weren't the economic books right? Well, it's because all other variables were not constant. The Chinese, most currencies in the world trade and float against other currencies, naturally by the economy, by how strong the economy is, like the dollar. The other nations obviously think that the U.S. is going to have a strong economy, which is why the dollar went up after the election. So they thought it would be weaker maybe earlier in the year, and that's why the dollar was weak earlier in 2024. So what the Chinese did last time that Trump enforced tariffs on them is the first thing they did is they devalued their currency by like 12%, because they set their currency manually to the dollar. So what that meant was it took about 12% out of the 20% tariff. The second thing they did is they're relying on us. If we don't buy stuff from China, they're kind of screwed. So, because we buy like 80% of their stuff, because Europe doesn't buy a lot of their stuff and the rest of Asia doesn't buy a lot of their stuff. So China needs us more than we need them. So they have to sell it because they have all these people that are in these plants producing stuff. So the suppliers over in China lowered their prices. Distributors in America and some retailers took it in the shorts a little bit, but most of the 20% tariff that Trump enforced last time on China was essentially absorbed by the lowering of the yuan and also by suppliers lowering their prices. So why would you not think that would happen this time? China's in the same situation. They're overproducing in China. They have a massive labor force that if they can't sell us stuff, they can't employ these people, and China's already, even though we have a huge trade deficit with them, they're already in problems. They have to sell the stuff because they can't sell it to anybody else. And India is eating their lunch right now. So, if you came to our political event, one of the things I said was that Trump oftentimes uses the threat, instead of using the threat of the military, he likes to use economic threats against his opponents to get his way. And so you saw what happened with Canada when he said he was going to put tariffs on Canada, Mexico, and these other places. They tend to agree after they are threatened with the tariffs because, again, they need us. Mexico needs us to buy avocados from them more than we need avocados. So I don't know that the tariffs will have a negative effect because all other variables will not be equal because the other countries will change what they're doing, essentially. Artificial intelligence, this is a huge thing. If you saw yesterday, the victory lap at the White House, where the CEO of Oracle, the CEO of SoftBank, and the guy that runs OpenAI were in the White House announcing this $500 billion AI project for data centers in the United States. I don't know, $500 billion seems like a lot of money to me. So that's a huge investment if they actually pull it off. And it's not the government spending the money, it's the private sector. So we're not raising taxes or doing deficit spending to do this, so it's a big deal. And what Altman said, who's the head of OpenAI, he said, last year and the year before that, NVIDIA and all the other AI stocks were building things. Well, now we're getting traction with AI. Things are actually happening. Emmett uses ChatGPT a lot in his MBA thing. Apparently it's encouraged, so it's not like he's cheating. We have used it several times for different things, like with portfolio stuff, where Andrew and I, who are the old bald-headed guys on the team, allegedly wise, we'll come up with something and then we'll run it through ChatGPT or run it through an AI simulator, and we oftentimes come back with the same answer, more than not, and we're like, okay, well, either the machine's getting smarter than we are, or the machine's not as, we're dumber than the machine, maybe. So, but what they're talking about is, especially in the medical community, a lot of this stuff is now getting traction, and people are starting to use it, and it's making us more productive and giving us more power back and more time back in our day. So we're starting to see AI actually having a ripple effect on the economy, and it can really help with the unemployment situation, what we're seeing. So geopolitical threats, a lot of that stuff is kind of tamping down. There was a lot of bipartisan cooperation apparently between the new administration and the past administration to negotiate the Hamas thing out. Between the Iranians losing all their air cover, losing their air defense system, Syria collapsing, and then Hezbollah collapsing. You know, the Hamas was out on an island, so they finally had to agree to something. And of course, Trump said that he was going to make their life miserable if they didn't give the hostages back. So but essentially Biden negotiated it, and because Trump was holding the hammer, we got what we wanted, essentially. So it was a win for everybody. So I think sometime this year, the Ukrainian thing will come to an end. I think they'll end up negotiating a deal where Ukraine will give back the land that they have taken from Russia, where they've invaded, and they'll probably end up giving some of the land that the Russians have taken in the far eastern part of Ukraine to Russia, but I think that's going to come to an end as well. There'll be new threats coming up, but I think we'll probably have a time of peace, hopefully, this year, or at least less war. The tax policy, the Tax Cut and Jobs Act that was passed in 2017 is up for renewal. They're talking about renewing that. It's important that that gets renewed this year because that 2017 Tax Act created the 12% tax bracket, which for most people ranges between for a married couple, it ranges between like $35,000 and $80,000. So for most Americans, especially lower income Americans who really can't afford it, if they don't renew that, they're going to get about a $4,000 tax increase, which is a lot of money for somebody making $100,000 a year, $500 a month. So that's probably going to get renewed, and there's probably going to be some other potential tax cuts and tax incentives in that, like 179 bonus depreciation is probably coming back at 100%. There'll probably be some other tax advantages for people coming to that. And the final thing is, if all these things happen, the Federal Reserve cuts interest rates, oil prices are less, tariffs don't cause inflation, we get better traction with AI helping things, we have less concerns about geopolitical threats, we have tax cuts, or we renew the tax cuts, consumers and businesses will spend more money, and that's good for GDP, which is good for the stock market. So we're very bullish on the market next year. We think that the policies that are coming and where we are economically in the system with inflation right now, that we'll have a very good year next year in the markets as well. So. First prediction, U.S. markets will have a good year. We're not sure if we'll have a 26-25% year like we've had the last 2 years, but we think it's going to be double digits, and depending on what kind of growth we get from energy and all the other things we talked about earlier, we think we're going to have a good year. Second, Developed international markets, emerging markets will be positive, but we think they're going to struggle because of a lot of things that are going on in the world, and the U.S. is going to be dominant again. We think oil prices will be in the range of $50 to $80 per barrel, and that oil and natural gas production will increase slowly. Like we talked about, the oil companies are not incentivized to really run out and drill a bunch of new holes in the ground. So something's going to have to cause them to do that because they like oil where it is. They're making tons of money. We do think that natural gas production, as I said earlier, is going to go through the roof because we want to export to our allies in Asia and in Europe. We think short-term interest rates will fall slightly. I think we'll get more than 2 cuts that the Fed chairman said, because I think we will get some deflationary measures from oil and interest rates falling. We think long-term interest rates will be range-bound again. Think maybe a little higher. Last year we said 3.5 to 5. We think the 10-year might get to 5.5 this year. So we're saying we're expanding our range from 3.5 to 5.5 this year. And we think if it goes to 5.5 again, that's a signal to the administration and others, hey, don't be going and spending all this money on these crazy programs. I think the dollar is going to remain strong. We think the employment market is going to remain strong. We think corporate earnings are going to rise. We won't have a recession. We think the housing market is going to remain strong because of the shortage of housing. Mixed inflation numbers continue. We'll have mixed inflation numbers, but inflation will continue to decline. You'll get these numbers. Some months will look like inflation's not cooling. You'll get other months and other numbers that'll look like the PPI will come in one way and the CPI will come in another way. There'll be mixed numbers throughout the year, but inflation will continue to decline slowly. And finally, we'll have volatility for all these other reasons that we've talked about in the past. So those are our predictions for next year. Our positioning, how we're positioning assets for clients, depending on your risk tolerance, 40 to 90% in diversified equities, 30%, 0 to 30% in alternatives if you have an appetite for that, and then 10 to 40% in short-term intermediate fixed income securities, again, is kind of what we're doing. If you have the appetite for longer term, for the duration, the fluctuation, we would go longer term, and we really like the mortgage-backed space as well. So we have some ways to buy that.